morning, everybody, and welcome to the Fred Report Technical Market Call for March 24th, 2011. Obviously, we've had some interesting times. Usually when I go away on a trip is when the market actually decides it's going to blow up and do something weird. Certainly the earthquake in Japan caused that. However, the net result of all of the fluctuations was we went down and tested the 126 area that we thought we would test. Right now we are looking for the market to actually rally into the end of the month, March, and then our weekly and monthly charts are going to possibly be overbought enough to make us cautious again. Given that, we want to see this market close over 130 on the SPY by Friday. That's about 20 cents from here. It looks very likely. In terms of sectors on this rally, we need to watch out for a couple of things. Principally, technology has come down much more than I would have thought, although, again, we've been an equal weight on technology. Everyone and their grandmother is overweight technology, and I would expect some more downgrades. We'll talk about that in the stocks section a little bit. But I would be watching your technology stocks here and looking to possibly lighten up between now and the end of the month if these start to weaken. The other thing that's been of interest to me here is the financials. The XLF, instead of rallying on news that we're going to see dividends in some of these bank stocks, it's actually sold off a bit. Concern on the XLF is that it's actually building a head and shoulders top, especially if it stays below 1650, and that head and shoulders top implies a move down, and if we do correct from sometime at the end of March down into May like we're thinking that we could do, that correction will probably be led by financials. Should we do that correction, by the way, it will set up a great second half of the year. This is what we're expecting and indeed hoping for. The sentiment numbers are not improving that much. Percent bears is at 22% in spite of all this hoorah. I'd like to see that number closer to 30%. Put-call ratios have improved a little bit, but not enough. So I'm still looking at rally into the end of the month and then possible correction. In terms of the bond market, we did test the 94.50 area you thought we were going to test. That was our target for the move. Our accumulation model still suggests there is some upside, but not a huge amount and maybe not as likely. But if you're in the bonds, as long as they're staying above 92, you're probably okay. And above 93.40, you do have a chance to head for 97.98 on the TLT. We're expecting, again, rates to fall now and then rise into the end of the year, ending up about where they started for the year, i.e. no net big change, but there is some concern. In terms of the commodity markets, they're definitely moving contra-seasonally. Given that, though, we got to have positions in these. I would expect a sharp drop here in gold and oil to get overweighted, but that may not happen, and that's why I want to have positions in these. Obviously, huge amount of headline risk in here, but we are intermediate-term bullish on these commodities nonetheless, and looking for a rally in them in the second half of the year. The DBC, our favorite commodity ETF, as long as that stays above 27.50, the trend on these is definitely sideways and almost certainly up as well. In terms of international, no change. We still see the possibility of money moving from Europe and such into our markets. We note the Portugal news today. If the FXE, the Euro ETF, can pull down below 140, that's a sign that this dollar is actually going to start to get underway. And our accumulation model suggests that that is the case. And if that happens, we could be treated to what we've been looking for in the second half of the year, i.e. a rally in the commodities and a rally in the dollar as well. Don't forget, commodities and the currencies have a tendency to move inversely to the dollar when you are in a recession, but once actual supply and demand relationships for the dollar take hold, for the commodities take hold, you will see a move up in the dollar and commodities, i.e. both will trade on their fundamentals. With that, let's move to some individual stocks.